Welcome back, everyone, to Lamb's Cryptoverse. Today, we're going to do something different. There's going to be no PowerPoint presentation, no charts. Yes, I do love charts, but no charts today. But we're going to have one thing today, and that's this. This is my daughter's chair. Notice it has four legs. I mean, it's a chair. It's on a bar stool. She's not going to bars right now. She's kind of young. It looks like it's from a dollhouse, but it's actually a real chair. She actually sits in it. And so what I want to talk about is how this market is like her chair. And I'm only going to keep it down to the KSS method. Keep it simple, stupid. I'm just going to talk about four things holding up this market in terms of risk. And yes, I love to talk about risk, and I'm going to talk about risk today. So the first thing I'm going to talk about is what's holding up her chair. And this chair is basically the market. So the first one is the price to earnings ratio. So this is pretty easy, but let's keep it to the basics. When a PE is high or going higher, it means equity is going higher. It's pretty simple. So the price to earnings ratio goes from 10 to 20, and that's what's happening now because the S&P 500 is a weighted index. And as you know, because of artificial intelligence, the weighting of that index and the associated price to earnings ratio has been pushed up because stocks like the FANGs, old Facebook and Alphabet / Google, Netflix, and we're even Tesla now, and Microsoft, and of course Nvidia, they're pushing up the market. So the PE ratio has reached one of its highest levels. So even though we're in a bear market, it just came out of a bear market, the PE ratio is already at one of the highest levels it's ever been. I forgot what it is. The forward ratio is around 19. It's pushing 20. So this leg, my friend, is bye-bye. So you can't sit on that leg. The second leg is right here. This leg is related to the P ratio, and that's the earnings of the market. So the earnings of the market have been, I guess, growing, but then they steadied. And they steadied because there were some tech layoffs, things like that. And now people are saying that maybe we're at the tipping point. So I was thinking, oh, we're at the tipping point of recession. But some people are saying that this economy is tipping into an expansion again. So maybe earnings growth are coming back. But right now, that hasn't happened yet. So let's just be conservative here. So what I think is happening is that the economy is tipping into recession. Yes, I've been saying that for like 10 years now. But if you look at the ISM number, the ISM PMI number, that's a Purchasing Managers Index number, that number is down to 46. That is a very low number, and that number has been like that for months. And that's a recession-like number. So I think earnings are going to be coming down. Even if they don't come down and they're flat, that's not enough to push the market higher. So that second leg is bye-bye. That you could just cut it off. So then we've got the third leg. And that third leg is a pretty broad leg. That's what I like to call liquidity. And I say it's broad because there's all kinds of liquidity and factors that come into liquidity. First of all, there's U.S. liquidity, and then there's global liquidity. I would say global liquidity, because I want to get out of the way, I'd say maybe it's been going up a little bit because China's been putting stimulus out there. But a big part of global liquidity is what's going on in Europe. And as you know, Christine Lagarde had a big meeting last week, and she said, and she keeps saying that she's going to keep liquidity tight. She didn't say the word liquidity. She said she's going to keep rates tight, rates going high because inflation is pretty high. And in the UK, which is outside of Christine Lagarde's scope, UK's inflation is out of control. So basically, you've got tightening liquidity almost everywhere in the world, except Japan. And they're in their own world, literally. So you've got tight global liquidity, so I've got that out of the way. So now I want to talk about the U.S. and the factors that come into U.S. liquidity. So you got the one that you hear about in the news all the time, and that's the Fed funds rate. The Fed funds rate was held last month in June. But that's just, in my opinion, a one-time event for now because the Fed raised rates, I think it was 10 times straight since March of 2022. And they said, you know what, let's hold because we need to see what's going to go on with what's going on with the market because remember, when the Fed raises rates, there's up to a year or more than a year that it takes for the economy to feel the effects of that raising of the rate. So that's why the Fed halted the raising of rates. However, the odds of the Fed raising rates in July are very high. So basically, the Fed, and this is Jay Powell too, has said they're going to raise rates and their comments are hawkish, meaning they're jawboning the market. They're jawboning the market into interpreting that we're going to have higher rates because they want to make sure that the market is comfortable with the higher rates because if the market's not comfortable, things could crash, things could break. That's why the Fed governors are speaking out on almost weekly, even not, if not daily basis, saying that they may need to raise rates. So that's one way of keeping liquidity tight. The other way is the Treasury TGA. That's the Treasury General Account Balance. And we heard about this in the news when the debt ceiling was in news and it was a debt ceiling crisis. So because it was a debt ceiling crisis, the Treasury was not able to refill that Treasury General Account. Now that's refilling that account is going up dramatically. And the refilling of that account removes a minimum of $700 to $800 billion from liquidity in the United States. And the third way, and there's many ways, there's a discount rate, reserve rates, the reserve rate requirements of banks. There's lots of ways in which the Fed can tighten liquidity. I'm just going to go over three. So again, the first one was increase in Fed funds rate. The second one was what I just told you now, the Treasury TGA account. And the third way is what's called quantitative tightening, QT. Now, this was supposed to go down quickly. The Fed's balance sheet was about $9 trillion. It was supposed to go down quickly during 2022. And I said in previous videos that it would not go down quickly. And at least I was right about that. It has not gone down quickly. You saw what happened in March. We had the Signature, Silvergate, Silicon Valley. Yes, banks that start with the letter S. Silicon Valley, SVB, bank failures, bank runs. And when that occurred, what happened was the Fed had to stop its quantitative tightening. And so the Fed balance sheet, you can see my hand here, went down slowly and then went up quickly in March, April. And now it's going back down slowly again. So what I'm saying is that liquidity has been tighter as of 2022, and it's going to continue to be tight in 2023. There will not be a Fed pivot. Just keep that in mind. In my opinion, and you can look at other people, listen to other people like James Bianco. He's a market economist. He and many other economists, market economists. And I like market economists because they're more global macro and they're less with theory. They're like, what's really going to happen? And these economists are saying that liquidity is going to remain tight. Actually, James Bianco just mentioned something I didn't even know about today about the base effects. You know, inflation has been coming down quickly, and some of that's because of base effects, but there's another base effect. There's the secondary base effect. But basically what he's saying is inflation's come down so quickly that now's going to be the time where there's very little wiggle room for inflation to go down. The easy cuts in inflation have already occurred, like in commodities and oil, for example. So listen, I've talked to you about the three legs. Usually people talk about the three legs of a stool, but I'm going to talk to you about four legs of my daughter's chair. So we're missing one. One leg is cut, two legs is cut, the second leg is cut, and third leg is cut. There's only one leg holding up all markets, and this is crypto. Remember, this is Len's Cryptoverse. And Bitcoin is attached to the hip of the macro economy. Bitcoin is very attached to liquidity and things like that. So that's why I'm talking to you about this. So what's the fourth leg? What is holding up Bitcoin and what's holding up equities and all risk assets? It's one thing. People talk about many things, but it's all related to one thing. It's sentiment, my friends. If you look at the Crypto Fear Greed Index from alternative.me, if you look at the BTC tools, Bitcoin Fear Greed Index, it's at greed. If you look at the CNN Fear Greed Index, and that's for equities, meaning stocks, that hit 82 today. 82 is one of the highest numbers ever hit on the CNN Fear Greed Index. I don't have the index going back since it started, so I'm not sure what it is, but I can tell you that we must be at the top 5% of the highest readings. And I have my own sentiment index that I've been working on since I think it was the mid or late 90s. And that index is at one of the highest greed levels it's also reached in 3 decades. But it's not the highest because I don't want to get too much into details. But after a bear market or during a bear market or an event like COVID-19, what happened is my index at least doesn't get too much into complete extreme greed because there's a lot of almost like post-traumatic stress. So people are always still a little worried, even when they're kind of giddy. There's a little worry. And if you look at the options market, this is what's called the smile on options. I know I'm getting too detailed here, but if you look at options pricing, what happened after the 1987 crash, there was something called the smile that occurred in options pricing. And if you're looking at the Black-Scholes option pricing model, and this smile was created because of this implicit fear of post-traumatic stress that occurred after the 1987 crash. So that's why my model, even though it doesn't rely on options, it's still not an extreme greed. Sorry for the complication. So let me just summarize before I go off into a tangent on Greeks and delta and option and theta and all that. So I want to summarize it to say that there is nothing holding up this market except for sentiment. This is sentiment. Everything else, like liquidity, the price to earnings ratio, and earnings per share, these legs have disappeared. So the market has nothing to stand on. I just want to say one PS, I should say. When there's other factors that people may say that are holding up the market, I'm tranching those. I'm grouping those together into like sentiment and PE, earnings, and liquidity. For example, people are talking about flows, that there's a lot of flows going to market, and that is true. I think those flows can be put into the bucket for sentiment. Because if you look back a few months ago, those flows were bearish. There was a lot of selling of S&P futures, for example, amongst hedge funds. But I want to say those flows are reversing now. So again, I think there's a lot of risk in the market. So why take the chance? Just be disciplined and do DCA. Remember, DCA is dollar cost averaging. That's the only way you can live to fight another battle. Thank you, my friends, and enjoy your 4th of July.